My name is Potter, co-founder of Bozrite Group, here with partners Sean and Anneka Mistry, mortgage agent. We're going to be explaining about the home buying assistance program, what Anneka's her specialty is with this program that she has, and yeah, go from there. Sean?
Yeah, if you guys have any questions, leave it until the presentation is complete. I think this will be a very informative, beneficial presentation, especially for first-time home buyers as well as investors. I won't go too much into detail, but just high level where you're able to put down 5%, and your lender's also matching that, not matching it, but putting down 15% to make it 20%. So this will be a great program for everybody. Anybody trying to look to get into the market. We know the GTA is very, very expensive, and it's not easy to get in. So this is something that provides you a helping hand and to obtaining home ownership.
Cool.
Okay, perfect. Thank you guys for having me. So I'm Anneka. I'm a mortgage agent with Dominion Lending Centers, Expert Financial, and one of the programs that we have access to is down payment assistance. Before we even get there, again, this is me. I've been a mortgage agent for several years. One of the main reasons why I actually got into the industry is because when I bought my first home, believe it or not, nobody told me that I needed tenant insurance and I needed landlord insurance. So my unit actually flooded about 2 years after I had purchased it, and I had no insurance. So I had to actually fork a bill for $10,000 out of my own pocket. The deductible from the condo actually went up to $25,000 at that point. I still have the condo to this date, but obviously I have insurance and all that stuff as well. But it was just a lesson learned for me, and I realized if I had the opportunity to educate people on what they do and don't need and get them set up on the right foot when they're getting into purchasing a home, and especially when it comes to signing something. I don't know if you guys are like me, blindly signing things. I wanted to make sure that people weren't going into blindly signing mortgage contracts. So when you get your commitment letter with me, I make sure I explain everything to you. You know exactly what binding agreement you have with whatever lender you sign with. So if you have your phones out, you want to follow me on social media, I'm always posting tips on there. So go ahead and you can scan. I'll give you guys a minute if you want. Or not a minute, I'll give you guys a couple of seconds. I think everybody's pretty well versed with using their phone.
Yeah.
But free to add me and follow along on the mortgage journey there. And then also make sure you go ahead and you add the Bozrite Group as well, and follow them on Instagram as well. They're also always posting really insightful stuff as well. So again, thank you guys, Sean, Butter, and Donica, and just the group in general for having me. I'm going to just jump right in. Again, if you guys have any questions, feel free to, you can raise your hand and we can answer them at the end, or just go ahead and put them in the chat and then we'll get to them at the end as well. If I'm going too fast, somebody just say slow down or re-explain that, and we can go back and re-explain it to you.
Yeah.
Thank you.
I'm just going to jump right in. So what are some of the biggest challenges home buyers are facing today? So when you think about it, a lot of the things that come back are down payment constraints, qualification constraints, location, pricing, appraisal value, just supply, demand, monthly payments, interest rates. There's so many things. One of the biggest points of contention for people is down payment constraints. Frankly speaking, a lot of people do not have enough down payment to get into a home. So I'm not sure if you guys are aware with traditional lending, but what happens with traditional lending is if you have a mortgage that's $999,000 or below, your down payment can actually be less than 20% down payment. And what happens there is when you get an insured mortgage, you have to put the mortgage insurance premium. So if your mortgage is going to be, let's say, $500,000, what you're not accounting for is that additional mortgage insurance premium. But this is what allows you to put less than 20% down. Now, when you get a mortgage over $1 million, your minimum down payment becomes 20% down payment. At the end of the day, regardless of how you split this, again, home buyers do not have sufficient down payment to get into the market or get the home that they desire. What if I actually told you that there's a program that could actually help you get into a home up to $1.67 million, and you only have to put as little as 5% down payment? What I'm talking about specifically, it's the down payment assistance program. So with the down payment assistance program, it allows you to actually purchase a $1.67 million home, again, with 5% down payment, and that's for 5% of your own funds. Whether that's borrowed from family, whether from your investments, whether it's from your RSPs, whether it's, borrowed from your sibling, pulling out of, previous home that you have, it has to come from your own sources in a sense, so it has to be rooted from you. And again, up to $2.5 million, you can purchase a home up to with 10% down payment. In order to qualify for this program, like there's no kind of hidden way of getting it done. You still have to income qualify, you still have to debt qualify, and you still have to fall under the standard stress test. Most people still fall under the standard stress test when they're qualifying, but what happens is they just don't have the down payment. So you may be wondering, how is it even possible that you could actually, purchase a $1.67 million home with just as little as 5% down payment? It's through a company called Ourboro. I'm not sure if you guys have heard of Ourboro. They're coming into the market. They started helping with this program last year. They really started blooming last year, and they've helped several families get into homes. And it's a really great way for them to just get people into the house for today's pricing, where they can actually partake in the appreciated value of the home. Mm-hmm. So before we go any further, I'm just going to tell you a little bit about who Ourboro is. So Ourboro, I am not Ourboro. I'm affiliated with Ourboro in the sense of I help facilitate mortgages for them. So I'm not the one that's going to be lending you the money by any means. If I could, absolutely I would, but I'm not the one that's going to be doing it. Ourboro is a Canadian owned and operated real estate investment company. What they do is they help bridge the gap between the 20% down payment and getting you into the home that you desire. So as long as you can come up with 5% down payment, Ourboro will put in the additional 15% down payment. And what that'll do is that'll get you to a 20% down payment. That will allow you the ability to actually get into the style of home more than likely that you're looking to acquire without having to come up with the 20% yourself. So what happens today is a lot of people, if they had 20% down payment, they could, get an $800,000 home. The issue here is that they're not able to come up with that 20% down payment. So that home ownership goal just seems further and further and further away. The way that Ourboro helps is they actually co-invest up to $250,000 into the home with you. So what they'll do is they'll contribute that straight towards your down payment, and then it gets you to 20%, which then boosts your ability to purchase a home. So the way that it works is they actually contribute again to the down payment, and with them contributing to the down payment, what happens is there's an equity split in your home. So they own a percentage share in the home and you own a percentage share in the home. You may be wondering, what happens when I sell the home? How do I get my money back? So what happens is when it comes time to either sell the home, or you can also refinance the home depending on the value of what the property is sitting at, the proceeds are then split based on the equity percentage that's derived off of the initial down payment. If you're wondering, what does that mean? I'm going to go over an example, so don't try to rack your brain over it too much. I'm going to go over an example with you guys as well. And if you're wondering how Ourboro makes money, the way that they make money, because again, what they're giving to you is not a loan, and you're not technically paying interest on it. What happens is they partake in the future appreciated value of the home. So they will stay in this with you for 30 years if you really want them to, but 30 years is the maximum that they will stay with you. After, and when I say stay with you, I mean like stay on being in second position on the home so that they have an equity stake in the home as well. Ideally, what this company is looking for is for your property to appreciate by at least 6% on an annual basis. I'm just going to go through an equity split example. So for example, if you were to have purchased a $1 million home, so that's the first figure there, your typical down payment would have to be 20%. So if your mortgage is 80% down payment, 80%, and your down payment is 20%, if you were to look at something as a form of an equity split, you'd be looking at splitting that 20% down payment between you and the Ourboro company. In this example, let's say if you had 80,000, that's 8% of $1 million. If you put 8% down and Ourboro put 12% down, you now have a combined 20% down payment. The way that the equity split would work in this case is your percentage would then be 40%, and Ourboro's ownership percentage would be 60%. And again, that's based on the initial down payment of you putting in 8% and Ourboro putting in 12%. Now you may be wondering what happens when I sell or refinance this home. So after 3 years, let's just say we're using a 3 years, we're saying around 6% appreciation on a year-over-year basis. that $1 million home is now worth 1.2 or just under $1.2 million. So what happens is if your sale price is 1.19, you subtract whatever is remaining on the mortgage. So let's say you paid the mortgage down to $765,000. Your net proceeds are now $425,000. So you may be thinking, okay, that 425 is going to be split between us. Yes and no. What happens is your principal amount, so that's the amount, let's say you've paid $34,000 towards this principal on your mortgage over the 3 years, that money goes back in your pocket. So what you're actually left with is $391,000. That's the additional equity in the home after the appreciated value has gone up year over year for 3 years. So you as a client, remember, you put in $80,000 initially, you are walking away with $190,000. Ourboro is walking away with $234,000. So again, you would be the 40% and they would be the 60%. So that's basically how the equity split would work when you do a sell or you do a refinance. Going a little bit into the refinance, what happens is if your property has appreciated enough in value that you can actually buy the equity partner out, you can use that full appreciated value of the home, do the refinance, and we can actually buy Ourboro out of the property for you. Well, you can do it. I'm not going to do it. You'll be doing it. This is a purchasing scenario. So it's a lot of numbers on the page. I'm going to go over it with you guys one by one. So I would just focus on that first box on the left here. So if you were to purchase a home by yourself, these are insured mortgage scenarios. So if you put less than 20% down, let's say your annual income is $85,000. If you make $85,000, if you're looking to go and get a mortgage and you're saying, hey, like I have the bare minimum for down payment, what you would qualify for with standard lending would be a purchase price of $300,000. Anything above that would be your down payment, meaning your purchase price would be $300,000, your down payment would be $15,000, which means that brings you to $315,000 for your overall housing value that you could look to get. Now, if you were to use a down payment assistance program, somebody who makes $85,000, if they hypothetically come up with 20% down payment, they could now purchase a home for $550,000. In this particular scenario, we're not asking you or telling you you have to come up with 20% down payment. You only have to come up with 5% down payment. So your minimum down payment now becomes $27,500. So again, if you make $85,000 and you can come up with $27,500 for your down payment, you could get a home for $550,000. That does take into account some condo fees and that does take into account taxes, but this is just a scenario that you could possibly look at. And again, I'm just using the $85,000. I know the annual average income in Ontario right now is in and around that price range, but of course you could buddy up with somebody else. You could be making more money as well. So there's a couple of other scenarios. And for example, let's just go to the very, very high end. If you and your partner make $160,000 combined income, with less than 20% down payment using standard lending, you would qualify for a $650,000 house. Now using the down payment assistance program and you only have to come up with 5% down payment, you could purchase a home for up to $1.2 million. So these specific scenarios, the ones on the right-hand side and the left-hand side, are basically for people who have little to no debt. Obviously, if you have debt, then your purchasing power will come down slightly, but those are individual scenarios that we can go through when we get to that point and you want to explore your specific options. Does anybody have, I'm just going to stop here for a second. Does anybody have specific questions on this slide?
Don't be shy.
Just going to take a pause for a sec. Okay, I think we're good. So I'm going to keep going. It might be very confusing. So you may be like, hey, I don't want to ask a question. You want to ask a question later? More than happy to have that chat with you.
I have a quick question. Maybe it's not so much think about it, but let's just say you're making 130, but you do have that $60,000. Would you be able to still go up to 1.2?
So if, sorry, say that again. So if you
let's say the
have
income
100,
of you, your partner, or let's say a group or whatever, you guys are qualified under the 130, but you guys have 60,000. Would you be able to get the 1.2, or you're still stuck at the 900,000?
because the income was 130,000, you're capped. So basically, when you go for a mortgage, you're always capped based on your income. So they take a combination of your income and they take your debts, and based off of that, they determine what your purchase price would be. So your carrying costs for the mortgage on a month-to-month basis, taxes and all that stuff, they factor all of that stuff in. And based off of that, this is what the hypothetical purchasing scenario is. Now, in the case of making $130,000, if you did want to try to purchase a $1.2 million home, let's say if you had a sizable down payment, it's possible to do. You would just have to come up with the difference of what you wouldn't qualify for.
Got it. Thank you.
So this is a recent client scenario I just wanted to go over with you guys as well. So a recent one that just funded with Ourboro is, it was a husband, wife, and 2 kids. So the wife was going on maternity leave. The husband is self-employed and he's only declaring on his income tax. I'm not sure if anybody on this call is self-employed, but if you guys are, all the power to you, because I know that we are only claiming the bare minimum when it comes to our income taxes. But what happens is, if you do, or if you're claiming the bare minimum on your income taxes, we can actually use your bank statement. So that's what we did in this case. But in this particular scenario, these clients had found a $1.4 million home that they were really interested in buying, but they didn't have enough down payment. So through traditional lending, when we did the numbers, they didn't qualify for the 1.4. But looking at different solutions and entering Ourboro into the scenario, using their 20% down payment, they were actually able to get into the home that they wanted. So Ourboro helped solve that gap between the clients wanting to purchase a home and not having the 20% down payment. And then what ends up happening is, with the income, the husband, like I said, we used his 6 to 12 month business bank statements to help get him qualified for a mortgage. And for a wife, we actually was able to leverage her pre-maternity leave income. And we actually were able to also leverage her child tax benefit income. So a lot of people don't know that you can actually use these to help you qualify for a mortgage. But in this case, it was a combination of all of those things. So with these particular clients, so the husband is a general contractor. So his goal is to renovate the basement and increase the value of the home. And then he's going to be refinancing or selling the home. So in that particular case, what will happen is he'll be able to get the shared equity partner off of the property.
Sweet.
Yeah, so that's just at a very high level. I don't want to bombard you guys with too much information, but that's just at a very high level what the program is and being able to use 5% down payment.
Got it.
Nice.
Okay.
Does anybody have questions?
I'm just gonna open up the message screen.
I had a quick question to start off then. What would the interest rate roughly be? And also, would this be with, I'm assuming it won't be with a traditional A lender, it would be with a B lender?
So there is one A lender in the space that can do it. But with that particular A lender, you have to come up with a minimum of 10% down payment. No matter how you split it, you have to have 10% of your own. So a lot of people right now are only qualifying with the 5% down payment, and that is with an alternate lender. Well, what happens if you do this program, and let's say we go with the alternate lender, all you have to do is get the 1-year mortgage with them. And then what happens after a year, you can actually qualify. If you can qualify with an A lender, we can move you over and you'll get a lower interest rate. The reason why it has to be with these particular lenders is there's only certain lenders that are regulated to actually accept down payment from a third party. So I don't know if anybody on the call has tried to get a home before, but what happens is when you want to go for purchasing a home, your down payment has to come from your own sources or has to be gifted from a family member. And what happens is a lot of people don't even have a family member that can necessarily help. But with this program, like let's say if you wanted to do it, you could go through the down payment assistance program, and the down payment that Ourboro gives to you, the lender will actually recognize as your own down payment. And they're aware that it's coming from Ourboro. We do a pre-approval letter. There's approvals on both ends that are going through. So Ourboro is communicating with the lender. We are also communicating with the lender and Ourboro, and that's how you're able to use this program.
Got it. There's a question that says, does the program change if you're buying a secondary property?
Sorry, meaning, so the way that it works with secondary properties is, no, sorry, let me just go back. So for this particular program, if you want to actually get in with it, it has to be a property that is your primary residence. So it could be your 5th property, but as long as you are occupying it as like something you will be living in, then you can still use the program.
Okay. One more. Oh, it says, what are the effects of the capital gains tax if we purchase through this program on a secondary home? Well, I guess kind of covered it, right? It has to be a primary.
It has to be a primary residence, but let's say if it's, you know, you already have a primary residence, you make that into a rental property and you want to purchase another property, which you'll be living in. If you're living in the property, yes, you can use this program. When it comes to capital gains taxes, I'm not an accountant. So I would just say, speak to your accountant about capital gains taxes. Like nothing different happens with this than standard. It would just be whatever typically happens. So I don't want to give information, then you quote me and then it's wrong. So I'm just going to not comment on the taxes.
Okay. Another question, as far as with if you don't make the minimum amount on the income
The
side,
85,000.
yeah, is there any other solution, or would the other solution just be partnering up with more people to come up with that 85,000, the minimum
You
amount?
essentially would have to come up with the 85,000. The reason why it's 85,000 is the threshold. I mean, as interest rates are going to be coming down, there's a possibility that you could get in with less than 85,000, but right now it's 85,000, and that's basically like the bare minimum scraping by to get the $550,000 purchase price. But again, there are other solutions like pre-construction properties, but you can't use this program for it. But then it gives you a little bit more time to purchase a home or come up with down payment to get the home as well. But that's like, we can talk on a case-by-case basis.
Okay.
Does Ourboro offer other programs, or this is just anything else?
Ourboro is down payment assistance. So they specialize in the down payment assistance program. That's what their focus is. They're trying to expand to different areas. So right now, most areas are accepted into the program. But let's say Niagara Falls is not there yet, but we do have Hamilton in there, Kitchener, Waterloo, Durham, Peel, York, GTA. Yeah.
I just
So-
want to just
Go ahead, John.
Yeah, I just want to just just segue into like, this program is like a joint venture. So it's like having a joint venture with your friend, right? But with Ourboro, they're not going to be pressuring you for the money back, and they're not going to be pressuring you to sell the place or refinance it, etc. Like Anneka mentioned, this program is on a 30-year term, if I'm not mistaken. Is that right?
Yeah, so the program, you can keep the home with Ourboro for 30 years. So meaning Ourboro can stay on the property with you for 30 years. And then after that 30 years, like you have to sell, you have to refinance them off. They will not be a part of the program with you on a particular home for more than 30 years.
Yeah. So their goal is the appreciation value, as we're aware in Toronto, historically goes up, 5 to 7% each year.
Right. So,
Okay.
so just to get, I'm just trying to think right now. So Ourboro is going to be on the title as well, right? But
Second position. So they'll be in second position. Think of like an HVAC rental unit. So they basically go in second position behind the first mortgage, and the first mortgage would be with a community trust, home trust, Equitable Bank, or I'm not going to give you the A lender right now, but there is an A lender as well.
so technically, if anyone's thinking, they won't have the shots to be called, basically. So they're not going to be like, hey, we're going to sell it now, just because they put the majority
They can't, no, they can't force you. They can't force you to sell. What happens is, let's say if you get into this program with them and you start defaulting on your mortgage, that's a little bit of a different scenario, because then the bank gets involved, foreclosure, bank, like there's a different path that takes. But in the agreement with them, it does stipulate you have to make your monthly mortgage payments, and if they need to step in at that point, they will. But for the most part, they're on the mortgage, they're waiting for the value to appreciate, and they're waiting for you to basically buy them out.
Yeah, so that's what we want to, like, just to make sure when people are listening, is that you don't have to worry the fact that you have, it's basically like a silent investor that's just there just to wait to cash out in the end. Because a lot of people know that the average homeowner is 1 to 5 years to stay at either a condo or townhouses. There's always gonna be moving up to, because the family's growing or downside with whatever it is, right? So these guys are just there just to wait on the appreciation, and then they're not gonna harass you. Like, let's just say I go borrow money from my sister. she might knock on the door tomorrow and be like, "Hey, can I get that money back?" We don't have, that's something that you don't have to worry about. That's basically what we want to make sure that everyone understands.
Does Ourboro, are they in Collingwood as well? You're muted.
You're on mute.
Sorry. Collingwood, it depends on the specific area and the specific type of house. So if it's something that's going to be an Airbnb and it's a visible Airbnb, then no. We haven't had much luck out in Collingwood right now. Again, it's going to depend on the type of home.
Okay. When can you refinance?
You can refinance the next day if you really want to, as long as the property has appreciated in value by at least 6%. Ourboro will has no issue with the refinance to get them off the property.
Wow.
And if I win the lottery or get inherited, so I could buy out Ourboro.
Yeah.
Okay.
Yep. I have another client who they had family that were selling a home back home. So overseas. So what they did is they used the program, and in a year they know the money is going to be coming from overseas. So they'll be using that money to actually buy out the equity share of Ourboro.
Oh, this is a good question. What happens if the value goes down? You need to sell.
Yeah. So what happens if the value goes down? Ourboro actually partakes in the depreciated value of the home with you. So if you buy it for $1 million and it drops to 800, they also take part in the depreciated value with you. So if you don't get any money, they don't get any money.
So I'm going to speak for everybody. This sounds too good to be true. Is there a catch? Is there any fine print? What's the deal?
No, and I think we talked about this briefly as well, Sean. So it seems like it's too good to be true because you understand the program. For people who don't understand the program, it's kind of one of those, I don't know. The reason why it seems like it's too good to be true is because there's no upfront there's no like interest charges in a sense, right? So what happens is Ourboro, you have to think first time home buyers within, 2 to 7 years, most of them will sell their home. They'll flip it, they'll buy again. So what Ourboro is basically then going to do is as soon as people start selling, they're already getting their appreciated value back. So like their pockets are being refilled, the investors are getting their money back as well. Anybody who's keeping the property long-term, let's say even 10 years, they're okay with it because that value is going up on the property. And the fact that, again, this is just a kind of a side note, the fact that this company has come out and actually launched at a time where everybody's like, not sure what's going on with the housing market. The fact that this company even exists and is actually willing to put equity into multiple homes because they know appreciation in value on homes is going to go up is a great indicator to be like, hey, this is a great time to probably get into the market as well. Like no pressure, but just think about that. If somebody's actually willingly going on saying, hey, I'll take part in the depreciated value of the home, but I know for a fact that properties are going to appreciate in value, which is why I'm actually going to be doing this with you. It's a sign. I mean, everything else that's going on with the economy right now as well, rate drops that are happening, it's a great time to get in. And if you can get in and you can actually use this program and then you have an exit strategy, I would say it's probably one of the best things to do. You also don't have to exit if you want to keep them on there for 30 years and you just want your home and you don't care about the appreciated value. Buy the home, sit in it, you only put 5% down and you're always going to be a 5% equity owner in it or 25% equity owner in it.
Nice. So there is a question. I think you discussed this already, but how does the decision to sell happen? I'm assuming who makes that decision and how's that happen?
You as a client make that decision. If you're like, hey, I want to sell, and a perfect example is let's say the economy is not at 6% year-over-year appreciation on housing, and you see, consistently over 2 years that it's 4% appreciation. You're like, hey, like I want to get out of this home, like I want to sell, I want to start over, I don't like this area, and you're like, I'm with Ourboro, I want to take my appreciated value and I want to buy them out and I just want to start over or move on. It's a discussion that happens. So you initiate it. You say, hey, like I want to sell the home. I want to buy you out. They like to see 6% appreciation year over year on the home. Nobody can technically predict what's going to happen. We all, in our minds, all of us in real estate know that it's going to happen. But nobody has a magic 8 ball to basically say for sure it is. But if the appreciated value of 6% year over year is not there, it's just a discussion that has to be had. Every single conversation is going to be different. Every single situation with the client is going to be different. But if you truly want to sell your home, we just initiate that conversation, say, hey, we want to sell. And then it's like if 4% appreciation year over year, then we show the numbers, your real estate agent gets involved and says, hey, you know, it's only X amount year over year. And then we do the sell that way instead. So what happens is an appraisal will be done from Ourboro's end and an appraisal will be done from your end. And then you look at the market value and based off of that, you make a decision. Yeah, but ultimately no one can stop you from selling your home. It's your home. If you want to sell it, you can sell it. There's really nothing anybody can do.
Yeah, that's very helpful though. And you're like living in a house and you only have 5% down, that could potentially be $1.6 million. So it's definitely a great way for buyers that's kind of like looking for help and they don't want to ask like their family members, etc. You have someone that's, you know, as long as you get approved and qualify, definitely something that someone should consider.
Absolutely.
There's another question.
Yeah.
Yeah. Is the household income considered for the minimum amount or is it just one applicant?
No, that could be 6 people. And I obviously not 6 people, but what I mean by like it could be 2 people combined. Like maybe one person makes 40,000, the other person makes 25,000. They're sorry, 40 and 45,000. Like depending on what that is, like 85,000 is the minimum to get into the market specifically with this program if you want to leverage it.
Got it.
Yeah, sorry, it's combined household income.
Okay.
Cool.
Oh, this is great.
Anybody?
Any other questions?
Don't be shy, guys.
I could keep firing away.
Sorry.
With Ourboro, obviously they're a lender. What if they go belly up? Can they go bankrupt? Like, how does that work?
That's a separate conversation. They have investors backing them. They're also regulated. I can't comment on their specific financials. I'm not a part of Ourboro, but what I do is I help facilitate the mortgages. So based on what we know, based on what we've seen, they have the means to do it. They've been doing it. They're regulated. They're approved with lenders and they're getting into the space with multiple other lenders. So as they expand, as their areas expand, obviously their equity is also growing. Their investments are growing as well. So they are always going to have the means to do this. Like, let's say if there's a shutdown that happens and they can't do it anymore, everything that's been funded up until that point would have already been funded, right? So if they're like, hey, tomorrow we no longer want to do this program, then just nobody else can get into the market. So what I would say is if you want to get in. The company, the program, it's not going to go away. There was another company that was doing it, but that company did not survive.
Okay.
Yeah.
I seen correct me if I'm mistaken, Ourboro partnered with something with Canada, or they got the stamp of approval from them, or am I correct with that?
They're regulated. What happened is the government actually released an article. The article wasn't 100% correct, but the government basically released an article and it was a mixed combination of Ourboro's helping homebuyers get into homes with 5% down payment. So it was basically more like a press release, I would say. I think somebody got wind of it and they decided to publish an article about it. And it was also shedding light on the first-time home buyers program that actually went away. That was the government program that basically capped you at 4 to 4.5% of your income to get a mortgage to purchase a home. So that's completely separate to what Ourboro is doing. It's similar in a sense, but there's a lot less restrictions with Ourboro.
Okay. There's another question. You want to go about it?
Yeah. What about the folks who want to take advantage of Ourboro but has OSAP debt? Can you do an example?
Yeah, so it would depend on what your specific debt is. So what would happen is like you got to, for every 400, sorry, for every, it's for, I forgot the number off the top of my head, but I think it's for every $400 in monthly debt, it brings down your purchasing power by 100,000. So what happens is, and in this particular scenario, like I can do a scenario for you after, specifically because I've got to pull up the system. But basically, if you have debt, you can still purchase a home. It just depends on how much debt you have. And different types of debt are looked at in different ways. So somebody who has like an OSAP loan of 100,000, depending on what lender we're going to, the debt on the monthly payments is looked at in a different way. And then somebody who, let's say, has a $200,000 line of credit, that's also looked at in a different way. So although that $200,000 is maybe going to be more interest payments that you're paying. The debt and the way that it's looked at from a lender perspective is completely different. So it's going to vary on a case-by-case basis. But yes, if you have debt, it is also possible. If you have debt and only make $85,000, it's going to be a little bit harder. So if you have debt, you're going to have to be making a little bit more money in order to qualify for a mortgage or for this particular program.
Yeah. We have another question. What's the criteria to qualifying before lending? Is it okay moving forward in the partnership, or is it mostly just having 5% or more?
So you typically, it's your standard qualification, and I can send this through to you guys, and we can share with everybody as well what typical documents you need to qualify for a mortgage. But it's basically through standard lending. And again, with this program, there's a couple of different ways of doing it. But if you're a salary employee, it's literally your T4s, your employment letter, your pay stubs. That's what we use to qualify for income. If you're self-employed, we're looking at your 6 to 12 month bank statements. We're looking at your articles of incorporation, and we're looking at your T1s and your NOAs. If you want to go the A-lender route, or if you have like contract work or something like that. But again, if you're straight, just, I don't claim income on my T1s, I don't have T4s, I'm self-employed, we use your 6 to 12 month bank statements to help you qualify. Your credit score right now, the minimum credit score for this program is 500. Ideally, we want to know why you're sitting at 500.
What?
Yeah.
No way. What?
Yeah, we have 2 out of the 3 lenders who will consider a 500 score, but we need to know why you're at a 500 score. Ideally, like if anybody has a the 500 credit score, or if that is, we work to build your credit, right? We want to make sure you're building that credit. You have a reason. Like I had a client who had a 500 score, and that was because his mother was going through cancer. And that was a reason why, because everything was going on there, but there was a sale of a home happening. Once the sale happened, all the debt was going to be paid out and the credit score was going to increase.
Got
So
it.
as long as the story makes sense.
Yeah.
Yeah.
Okay.
Oh, that just opened like a lot of doors, because it's pretty good.
Yeah.
Yeah.
We have another question, Tatiana Newlin. How do car loans impact your approval?
So again, same thing. So for more debt you carry, the less of a mortgage you can qualify for. So if you're carrying a huge loan, like I would say if your car loan, if you're paying anything over like $300 on a monthly basis, like it's going to seriously impact. Even if you're paying $300, like anything above like that $100 mark on a month-to-month basis for something, if you can't pay down your credit cards, or you can't pay down your debts on a month-to-month basis, that's going to impact what you can afford for a mortgage. I have the specific numbers. I can't recall them off the top of my head, but I have an Instagram post that I can direct you to, and it'll give you the actual breakdown for every dollar you have in debt, how much you're decreasing your purchasing power by.
Got it.
Oh. What credit do A-lenders require? They're not publicizing the A-lenders right now. They're not doing that.
Yeah, you got.
No, they are. I just don't want to go into the whole A-lender thing on the call right now. Yeah.
Okay. Sorry
Yeah.
about that.
It's public knowledge in the broker channel.
Okay.
Yeah.
Okay.
Yeah. Like if we can have you can call me literally after this call, and I'll be like, this is the lender. It's just there's different qualifying criteria for it, because it is an A lender. With the B lender, there's more leniency with what they will approve. So the numbers that I showed you in this spreadsheet, those are not for the A lender. With the A lender, your purchasing power would go down significantly.
Mm-hmm. Another question. How is insurance handled for the property, and what liabilities do each co-owner have in case of property damage or other issues?
So the way that let's go with the land transfer tax. I'm just going to start there. What happens with land transfer tax if you are doing a 50-50 split? So if you're coming up with 10% down payment, Ourboro's coming up with 10% down payment, what ends up happening is Ourboro will actually help cover 50% of the land transfer taxes, and you'll cover the other 50% of the land transfer taxes, which is also really good. When it comes to insurance, it's your home. You are fully liable for paying all of the insurance. If something happens, if there's a flood or anything like that, your insurance policy has to cover you for what you need. So what happens with any type of lending is when you get your commitment letter between the lender and the lawyer and then the broker too, we'll always have information on where you need to go for your title insurance, what information you need to put on for property insurance as well, who it needs to be written to, how much it needs to be, and all that stuff as well.
Okay.
And Alicia, if you're wondering if as co-owner you mean like Ourboro, it's basically just you. So it's you're the face and everything. It's basically like your house, but you just don't have to come up with that extra 15%.
Yeah, it is your house. Like it's your house.
Yes.
You own the home. It's just somebody who has like again like a lien against the property in second position.
Yes.
If I came up with 15% with Ourboro, do the other 5? Is that
Yeah.
we can switch it
Yeah.
around as well? Okay. And then like you mentioned,
Yeah.
it could be 10. Okay, cool. Got it.
Yep. So Ourboro, the minimum Ourboro puts in is the 5%, and the maximum they'll put in is 15%.
Got it.
Right, but yeah, 100% you go reverse it. I had somebody again who put in 15%, and they just needed that extra 5% because money was going to be coming from a sale of another home that they had, and they just didn't have the equity that on hand, but they knew when they sold a home in the future they could use that equity. I have some people who they know that they have like a nursing job that's going to be coming up, and they're going to be switching the type of field or the type of nursing that they're going to be doing, and they know more money is going to be coming in. So again, they also are like, okay, my salary is going to go up. They're doing a projection for 5 years, and they know I just need this for 5 years, and then I can buy you up. Right. I also have other people who are like, I'm doing 50-50, so they put 10. Ourboro has put in 10, and they just are happy living in the home. And when they get to the point where they have the option to do the buyout, they can consider it, but they don't have an exit strategy in the case of extra money coming in or extra hours coming in. It's just simply, I have 10%, give me your 10%. We did the mortgage. They're living in the house in Mississauga right now. They are happy. They have no intention of selling or refinancing, but it's a conversation that as the home continues to appreciate in value, we obviously don't want our clients sitting on a property that's appreciating, 6 to 10% year over year, and 50% of that is getting eaten up by the equity holder. Ourboro, we want to make sure that the client is optimizing and doing the buyout if it makes sense for them, and then utilizing that money for themselves going forward.
Mm-hmm.
Another question, I guess, what are the potential risk and downsides that haven't been identified?
Yeah,
I know we're giving all the pros, but what's the cons? What's the cons?
So the thing is like, as we're kind of going over the pros, like the con is basically in there. The con is basically somebody else is owning the property with you. So the con in a sense would be like, let's say if you're putting in 5% and Ourboro's putting in 20%, your equity share on the property is now only 25%. Ourboro is 75%. So that's what some people look at as like the con in a sense, is what the equity share split is of the future appreciated value of the home. And I'm going to just give you an example because like you're asking about the con. So very transparently, like if you are buying $1 million home and you're only putting 5%, let's say that home appreciates in value by $100,000. That $100,000 is now split. You get 25,000, Ourboro gets 75,000. Right? But again, it depends on how much you have and what position you're in today. Some people also look at it this way of, I can only come up with 5% right now. It's going to take me another 10 years to even save enough to get my 20% down payment.
Well, if you can just go back to that slide where, if you just come in with 34, whatever it was, it's kind of just to give an idea of like the appreciation, let's just say for 3 years, you never had that amount anyways, right? So that's getting into the equity of the home.
Yeah, give me 1 second.
Sorry.
Hi, good evening. Sorry, I can't find the spot to type questions, and I joined a little late. So I just wanted to ask how long, I don't know if you guys addressed this at the beginning, but how long has Ourboro been around?
Ourboro has been around for many years. I can give you the exact number. They officially launched this program and kind of came more into the market last year of doing this, but they've been doing it for years prior to that as well. I'll give you the exact number. I honestly don't have it off the top of my head.
The capital gains, that's more
Accounting, your accountant.
more accountant. That's more something to speak with your accountant in respects to that.
See, just that.
Yeah, that's like that whole, yeah, the 250. It's a,
Yeah,
that's
it's
a
like
touchy subject
yeah.
for some people.
Yeah. So basically, this is what I was talking about. Like just having this 190 from your initial 5%. You know, it's a pretty good return.
Yeah, you're putting in 80% and 80,000, and you're walking away with over double that.
Yeah. So you never had that initial amount, and now here you are sitting down, getting a little bit, you know.
Yeah. And honestly, even if you have 5%, like having 5% doesn't mean that you shouldn't get into this because your equity split is only 25% of what it is. You're better off having 25% of something than
Then
having 100% of nothing.
100%.
Right. So I think
100%.
that's a lot of things that people are not realizing. There's a lot of people like the younger generation. There are a lot of them early 20s and like, I'm never going to buy a home because I'm never going to be able to afford it. And when I ask why can't you afford it? Why do you think you can't afford it? And they say it was easier for my parents. One, no, it wasn't easier for your parents. Interest rates were astronomical. And the price at that point, like let's say some of their houses, they only paid 400,000 for. 400,000 for them at that point in time is the equivalent of what we would be paying right now for like a $1.2 million home. So it was very hard for them back then, just as much as it is hard for everybody right now. But a lot of people are saying they don't have the down payment, and mom and dad are not going to help. I don't blame them. Mom and dad maybe can't help, but this program can help get you into the home.
Yeah, it's like an angel investor.
Yeah.
Just waiting to cash out whenever you guys cash out. That's basically what they're
That's
doing.
pretty much what it is, right? And the other thing is I know like we've had this conversation as well with I know some of your clients, Bader and Sean, is we're watching as the property is appreciating in value, and you're having those conversations with your clients as well of projected to increase by X amount. This is when we should look at potentially looking at a sell scenario, and then I come back and I help, and we look at the mortgage scenario to see like, will you qualify for a refi? What are we looking at in regards to your income, and if you can move to the A side, or do we keep you on the B side? So we're always kind of in it with you. Once you have us, guys, like we're here for life. Like whether you use this program or not, you have all of us now. If you have any questions, like we're always going to be here to help you guys through the home buying process.
Mm-hmm.
Is there any additional fees or costs associated with the program?
So with an alternate lender, there is a 1% fee. That's
Yeah.
standard, whether you use this program or not. Anytime you go to an alternate lender, there's always a 1% lender fee. It's because the lender is taking a higher risk.
Yeah.
And then for the program specifically, there's a $2,500 broker fee as well. Typically, brokers charge 1% as well on the alternate side, but for the program, with this program, we're not. There's only $2,500. That's taken from the brokerage directly.
Mm-hmm.
And a lot of people, when they say, "Oh, I don't want to, pay that, that's too much," we've broken it down. I've done this for numerous clients. We've looked at doing insured mortgages on the A side. That mortgage insurance premium is going to be more than what you would pay towards using, an alternate lender to get into the program as well. And I mean, there is the A lender as well, right? So you don't necessarily have to. If you qualify on the A side and you have 10%, that is an option for you as well.
Yeah, like you mentioned, at the end of the day, we want to get everyone home ownership and get everyone into the house. These prices will continue to steady increasing, and it will get harder and harder. The down payment will become more and more. So, someone wrote time in the market beats time in the market. That's 100% correct.
100%.
It's amazing.
Well,
Perfect.
it's
If there's no
8
more
o'clock.
questions,
Yeah, I don't think there's any more questions. If you guys have any more questions, you could reach out to myself or Bother directly.